What if you could build wealth with $0 in your pocket? Yes, sounds unbelievable, right? But let me tell you, it's more than just a pipe dream. It's an achievable reality that countless individuals have already made true. Instead of adhering to the conventional wisdom that tells us more work equals more wealth, you'll learn to prioritize advice from those who've already navigated the path to success. These are the trailblazers who've defied the norms and crafted their own blueprints to wealth. They teach us to focus not on the hours worked, but on the results achieved. To view wealth not as an end, but as a means to an end. Remember, every journey to wealth begins with a single step, and yours starts now. 1. Choosing a wealth-building career. The path to wealth isn't measured in hours, but in results. This statement rings true when it comes to choosing a wealth-building career or business. It's a shift in perspective that could potentially change your financial future for the better. In our society, we're often taught that the key to success is clocking in more hours at work. However, this isn't necessarily the most efficient or effective way to build wealth. The truth is, it's not about how long you work, it's about the value you create. Whether that's in your career or in your own business, the focus should be on producing results and creating value. Imagine this. You're a painter who gets paid per piece, not per hour. If you can paint a masterpiece in 2 hours that sells for $1,000, you've just made $500 per hour. Compare that to a painter who takes 10 hours to paint a piece that sells for the same price. That's only $100 per hour. The difference, results. The first painter's results are more valuable, even though they spent less time working. This concept applies to many careers and businesses. Think of a real estate agent who sells multi-million-dollar homes. They're not getting paid for the hours they put in. They're getting paid for the results they deliver, the homes they sell. And let's not forget about entrepreneurs who build successful businesses. They don't get paid for the hours they put in. They get paid for the results their business delivers, the value it creates for its customers. So, when choosing a career or business, consider this. Would you rather trade hours for dollars or results for wealth? By focusing on results, you can potentially earn more in less time, accelerating your journey to wealth. This strategy is not a get-rich-quick scheme. It requires skill, dedication, and a mindset shift. But if you're willing to put in the effort to produce high-quality results, the rewards can be substantial. It's not about how much time you put in, but the results you deliver. This mantra can guide you towards a wealth-building career that aligns with your skills, passions, and financial goals. Embrace this mindset and you'll be well on your way to building wealth. 2. Money makes money. Money makes money. And the money that money makes more money. Now let's talk about the magical realm of compound interest. Imagine a snowball rolling down a hill. When you invest, you earn interest. This is the beauty of compound interest. It's your money working tirelessly for you, even when you're sleeping. So, how does this work in real life? Let's say you invest £100. If your investment grows at a rate of 10% per year, you'll have £110 after 1 year. You've earned £10 in interest. But here's where the magic happens. In the second year, you're not just earning interest on your original £100. You're earning interest on £110. Now, this might not seem like a big deal at first, but let it compound for 20, 30, or 40 years, and you'll see the magic unfold. The snowball becomes an avalanche. This is why it's so crucial to start investing your earnings as early as possible. Remember, compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. 3. Diversification of income. Don't put all your eggs in one basket. This age-old adage rings especially true when it comes to building wealth. Having a single income stream is a bit like walking a financial tightrope without a safety net. If that one source of income disappears, you're in free fall. So how do we avoid this precarious situation? The answer is income diversification. Think of income diversification as a buffet. You don't want to rely on just one type of income. Let's break it down. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Stocks, mutual funds, and exchange-traded funds can all provide dividends, adding a nice boost to your income. Rental properties, on the other hand, are a bit more hands-on. They require upfront investment and ongoing management. However, they can provide a consistent income stream and potential appreciation over time. Side hustles are another exciting way to diversify your income. These can be anything from freelance work to selling handmade crafts online. The beauty of a side hustle is that it can be something you're passionate about, making it feel less like work and more like a hobby that pays. So why is diversification so important? Well, it's all about risk management. By spreading your income sources, you're not putting your financial future at the mercy of a single employer or investment. It also provides a safety net. If one income stream dries up, you have others to fall back on. Moreover, diversifying your income can accelerate your wealth-building journey, allowing you to invest more and reach your financial goals faster. Diversification is a wealth-building strategy that can weather any storm. And remember, it's not about how many income streams you have, but rather the quality and reliability of those streams. 4. Cutting back and avoiding lifestyle inflation. The key to wealth isn't earning more, but spending less. An intriguing statement, isn't it? It seems counterintuitive, but when it comes to building wealth, this is a fundamental truth. Let's delve into the importance of cutting back on non-essential spending and avoiding lifestyle inflation. When we say non-essential, we mean the extras, the frills, the luxuries that might be nice to have, but are not necessary for your day-to-day living. These could be anything from that daily latte at your favorite cafe to an expensive pair of designer shoes. Now let's talk about lifestyle inflation. This is the tendency to increase our spending as our income increases. It's the reason why, despite getting a raise or a better-paying job, we often don't see a corresponding increase in our savings. Instead of saving that extra income, we start eating at fancier restaurants, buying pricier clothes, or even upgrading to a bigger house or a nicer car. Here's the secret, though. If you can resist the urge to inflate your lifestyle every time you get a raise, and instead invest that extra income, you can significantly accelerate your wealth building. Consider this. If you get a raise of $1,000 a year and invest it in a low-cost index fund with an average annual return of 7% in 10 years, you'll have over $12,000. In 20 years, that amount could grow to almost $30,000, and that's just from one raise. So, the next time you're tempted to splurge on a non-essential item or inflate your lifestyle after a raise, stop and think, is this short-term pleasure worth the potential long-term gain? Remember, the biggest obstacle to wealth isn't your income, but your spending habits. Make wise choices, invest wisely, and watch your wealth grow. Building wealth from scratch isn't a myth, it's a journey. I've journeyed through prioritizing advice from successful individuals, choosing result-based careers, leveraging compound interest, diversifying income sources, and cutting back on non-essentials. Each of these strategies is a stepping stone on the path to financial security. Wealth building from zero. Start with nothing, achieve everything. For more financial insights, explore my money playlist showing up on the screen now. Remember, the journey to wealth begins with a single step. What will your first step be? Share in the comments below.